But one of the big advantages is when you move your properties from your own name, or your names, if there's two or more of you, into a limited company, you get an uplift in the base cost of those properties. And that can have a huge advantage. So put simply, if you've owned properties over a long period of time and they've appreciated in value and the equity is more than the debt, then there's good reason for you to incorporate in terms of A, the increase in the base cost, and B, of course, the value of the shares that you're going to get when you move your properties from your own names into the limited company. Some of the other advantages, which I'm sure you'll be aware of, are things like, obviously, you've got limited liability. Section 24 doesn't affect you. You can control your income, because when the properties are in your name, you actually pay the tax on the profits. Whether or not you use those profits for personal purposes, it matters not. Whereas, of course, if you have a limited company, you only pay income tax on the profits or the cash that you take out. So if you take a salary and then you take a dividend, you can control how much of a salary you can take. You control how much of a dividend you take every year. So you can control your income tax. Of course, the flip side to that is you pay corporation tax at 19%, and then you may end up paying income tax on top of that, depending on how much income you take. Something which people use incorporation for really well, and we have done this over many years, and well before Section 24 was on the radar, is to incorporate the property portfolio and then to use a trust to pass down the estate or the assets to your children. So if you are thinking about incorporating, and you do have children or other family members to whom you want to leave your assets, then don't just stop at incorporation. Go that step further and fully consider setting up a trust to see what benefits that has for you and if that works for you. And again, on the flip side, generally speaking, when you refinance, you'll have to, obviously, you might have to pay a higher rate of interest as compared to the properties being in your own name. You might have to pay stamp duty, land tax, unless you're a partnership and the partnership incorporates. So that's something to bear in mind. You'll have, obviously, legal fees, and you'll have to pay arrangement fees and valuation fees. So I've kind of quickly gone through that on the assumption that most of you either have covered this in the past, or if not, you can ask me questions and I'll be happy to answer them. But there's lots of information available out there which will hopefully point you in the right direction. So tread carefully when you're thinking about and looking at incorporating your property portfolio. Just because everybody else is doing it, it doesn't mean it's right, and it doesn't mean it's right for you, because every situation and every circumstance is different. And in tax, there is no one size fits all.